Today on Finance at 5, the S&P TSX Composite dropped again today, falling about 0.7%. Now this is significant because in the early morning, it was actually trading up about 0.5%. And there's a little concern here because after the 3% loss roughly yesterday and the day before that, you kind of expect the stock market to rebound a little bit today, but overall it continues its fall. Over the past week, you can see the total loss is 4.83%, and even the year to date has fallen below 0%. The S&P 500 didn't fall as much as the TSX, but it's still down for the day, falling 38 basis points. This is a significant loss on the past because you can see it's fallen almost 8%, and on the month, 3.9%. But looking at that year-to-date return, it's at negative 4.35%. Now, this is off the back of more virus concerns as markets are wary of how earnings and revenue growth are going to happen this year and how they might affect the coming years ahead. The Dow also continues its fall, falling 46 basis points today, making it a week loss of 8.15%. The Dow has been struggling this year. As you can see, the year to date is a loss of 6.62%. Surprisingly, the Nasdaq is actually up 17 basis points for the day, but overall, it's still tanked on the week, falling 8.5%. Looking at Europe, the FTSE was up 35 basis points, but still has that week loss of 5.76%. In Asia, the Nikkei also fell 0.79%, making a week loss of 3.74%. Oil continues its fall, falling to 48.69. It's about a 2.4% drop, and then gold also fell a little. Looking at currencies, the USD and the Euro had a really good day, climbing against pretty much every other currency. Overall, the Australian dollar fell a decent amount, pretty much versus all currencies, as well as the British pound. First up in the news, Germany's finance minister is making a move that could potentially end the restriction on government spending. So currently, Germany has a constitutional mechanism that makes it hard for the government to borrow past a certain debt level. And what he wants to do is kind of remove this, call it temporary suspend it, because there is a low growth there and they're worried about recession, especially with the coronavirus going on. So he's hoping that this will improve the whole region, not just Germany as a whole. The European Central Bank president also is in favor of this and hopes that this will have a positive impact all across Europe. So what he's kind of trying to do is move away from municipal spending and more towards centralized. I think this is because Germany has those negative interest rates, low interest rates that they hope to kind of capitalize on, kind of why not scenario. But overall, it's kind of an interesting development because at the same time, while they're going to be borrowing from the whole Germany, it is going to be focused on municipalities, and the municipalities will decide where the money's going. Moving on to Britain, the Bank of England has put in pressure on banks to remove the use of LIBOR. So if you don't know what LIBOR is, it's basically a lending rank for banks. Basically, each bank will submit what their rate is, and then they'll take an average of that, maybe removing the bottom and the top one. The reason that the Bank of England wants to remove this is because over the past years, there's come out documents that certain banks in Britain as well as the US were doing practices to manipulate what LIBOR is to improve certain loans they had and stuff on their balance sheet. So what they want to do is remove their use of this, have their own standardized thing. From what I understand, they just announced that they would be publishing a compounded index for the sterling overnight index average as a replacement for the British pound LIBOR. This is kind of an interesting way of doing it. They plan on having it out of there by 2021, which would be kind of hard to do because a lot of loans are based on it, especially variable rate loans. So currently what they're doing is that they have a 25% reduction on the value of LIBOR linked collateral that the banks have, so determining how much the Bank of England will be loaning them. So what they're also planning on doing is raising that 10% in October and then by 30% more in mid 2020 to hopefully phase it out by the end of next year. A quick update on the coronavirus. The total number of cases has reached 81,296, with total deaths being at 2,770 and a recovered amount of 30,359. Delta has also announced that they will be reducing the flights to Korea as virus has started to spread there. Canada continues to have issues with the rail blockades. So if you don't know what's going on in Canada, basically Native Americans are protesting a pipeline going through Alberta to British Columbia. Um, so kind of what happens is the hereditary chiefs are not wanting this to go through the territory, while the elected chiefs have all approved it to go through. So there's a lot of protests that are blocking rail cars and stopping the passage of basically railways. So this has led to CN Rail actually laying off 1,000 people, as well as Via Rail laying off a total of 450 people. So this could have a decent effect on the Canadian economy. This article here is actually saying that a total of 25% of small businesses that were surveyed by the CFIB reported that they've been already negatively impacted by the railways blockades. This puts a lot of pressure on Prime Minister Justin Trudeau, as he really has to decide whether he wants to focus on climate change or the oil and gas industry, because he's not making anybody happy right now, especially in Alberta, with the news that Teck decided to pull out their investment due to a lot of these issues going on. There's a lot of analysts that actually came out from the US that agree that Canada's energy sector is a lot harder to get things passed through, and this is a prime example of why, and the effect that certain people protests can have on the Canadian economy. Moving on towards company news, it was Lowe's turn to report their earnings. After Home Depot's big earnings release yesterday, you kind of expect Lowe's to come out with something pretty good. But while they did beat on their earnings, they achieved net income of 509 million and earnings per share of 66 cents. That's an adjusted earnings per share of 94%, which did beat earnings estimate of 91 cents a share. But overall, what they did miss on was the revenue. The revenue was only 16.03 billion versus the 16.15 expected by analysts. Now, this isn't a very good look for Lowe's, especially because you consider that sales to be kind of a staple thing, especially with Home Depot's strong numbers yesterday. For example, their stores at sales at stores opened was 2.5%, what was expected to be 3.2%. Home Depot's, on the other hand, came in at 5.2%. And a little kind of comparison on the sales perspective is Home Depot sales actually went up a total of 5.3%. These results have actually led the company's shares to fall a total of 4.8% currently. Another Canadian bank came out with its earnings today, that being CIBC. So they did beat in their profit estimates with a total adjusted earnings per share of $3.01 compared to the analyst expectation of $2.94. While this does seem kind of high, you have to kind of take into consideration that their unadjusted earnings per share was at $2.63 per share. The reason for this is they do have a lot of restructuring costs because the CIBC is trying to go on lowering their costs and improving efficiency, so they're getting rid of a lot of people in a lot of divisions. For example, they had a total of 339 million in the cost for just severance. So a lot of changes going on at CIBC right now. They're trying to change their interest expense. For example, their non-interest expense raised 11% this year just based off of restructuring costs. On the good news, though, the provision for credit loss is down, um, while Scotiabank and BMO's were up, as well as RBC's was down. So overall, kind of looks about in line. Canadian company Torstar Corp reported their Q4 profits. So they did achieve a profit this year. Last year they did lose a decent amount of money, but this is kind of primarily boosted by some one-time gains that they sold part of their divisions as ad revenue continues to drop. I think the ad revenue part is the really interesting part of this though, because we have seen a lot of advertising revenue, especially in standard media, take a hit over the years as a lot of these companies can't figure out how to boost their ad revenue and in turn lost revenue overall. A prime example of this is Chorus Entertainment, who have their stock's gone way down over the past few years, primarily due to continuing lower advertising revenue for the company.